Good morning, folks. Welcome back. We finished another week here at Guardia, wrapping up our Monday, Wednesday, Friday check-ins on the mornings, 9 a.m. live. You can view the recording afterwards on YouTube. Actually, for now, the videos are open, but also on our Discord, so you can view live. Welcome. Incredible week. Basically, we got the word from up above that the recession is canceled. If you read the tea leaves of what the Federal Reserve said yesterday in the beginning of its Federal Open Market Committee meetings, where they sort of tell the country how we're doing and what they are going to do to improve or control some sort of condition in the economy. And you've heard me beating the crap out of the dead horse that the three things that our economy and our markets lean on are consumer strength, corporate strength, employment market, interest rates. I said three, I named four, but let's call interest rates kind of the umbrella that touches all of those, because it's the main tool that the Fed uses. And so to summarize the comments, the market walked away from that meeting with a few conclusions. One, that it seems that inflation is subdued. Two, that the Fed is still focused on that. And three, that, we had this meeting in the middle of corporate earnings, right? We had all of the major companies reporting corporate earnings, and we kind of saw the porridge that was the right temperature, the three little bears. And we got that quote unquote soft landing, which is financial jargon for subduing inflation without destroying the economy. In the past 2 years, the U.S. experienced an economic contraction, an economic slowdown, but not a de facto contraction. We didn't have periods where the economy was negative, which is typically what you see when there is quote unquote tightening going on, which means interest rates going up and the government trying to fight inflation and stimmy explosive price growth on consumer as well as kind of industrial goods, because it goes across the entire chain. So, for all intents and purposes, the recession is canceled. And I think markets are going to continue to like that. I think it is the right sort of conclusion from these meetings, from earnings, and it's essentially a green light for U.S. equities to continue on this amazing rally they've had this year. With that in mind, for those of you that have spoken to me, for those of you that have chatted with me, my view at the moment is very happy with what the market has done, very happy with the model portfolio has done, but we're a little bit nervous. And this brings me to, one investing principle that I really, really like, especially as someone who, has a longer time frame of investment, believes in being long, believes in buying companies that you want to truly own. It's kind of a simple mental exercise, but when I ask people digging into an allocation conversation, it's like, wouldn't you like to be the owner of Apple Computer? Wouldn't you just love that? Walk around town, tell people, hey, I'm an owner of Apple. I'm a partner at Apple. We make great products. I'm proud of them. I'm proud of the culture. I think the future is really strong for the company. And, even myself, I go through this exercise and I always grin. I always get kind of excited when I do that asset test on a new company that I'm considering, and I start to daydream of like, imagine riding around town in a convertible, and it's like, I own Apple. And so that's what I like to see. And this leads me to kind of one of those major investment principles that I strongly believe in. There's many, it's not one size fits all. That's one of like my core tenets here at Guardia, is that there's thousands of investment books. All of the information's out there. You could teach yourself to be a financial engineer, a options expert, a probability expert, a quantitative analyst. You can do it all online. You can take Harvard courses, do it all yourself. But the problem is that we're all unique. We all have different psychological profiles. We all have different emotional profiles. And so it's definitely not one size fits all. What is the magic term that I've been digressing on so much? It is buy first, sell first. And these are things that change over time. They change based upon what your allocation is. but I consider myself and most of you folks listening to me that are in the Discord that are clients of Guardia are in the buy first group, especially because we should be thinking about buying high quality things long term, mostly in equities. We're younger. We should have allocations between 80 and almost 100% in equities if we follow sort of conventional wisdom. And so with that framework, I like to tell people, especially if they like to shop, to be a buyer. You know, when you see something that's fantastic in clothing, right? Some great leather boots, an amazing watch, a limited edition jacket of some sort by some designer. You know, people who really enjoy that stuff, they see an opportunity when it's staring at them in the face. When you see something like that, that would be wonderful in your collection, that you know will carry enormous value and maybe even appreciate over time and be a sought after collector piece, it's pretty obvious to purchase it when it's at a 50% discount or more at a store, especially if you're very into that subculture. This example can be applied across different themes. But when you see something like that, to you it's sort of a no-brainer. And with equities, building long term, any discounts that don't really make you doubt your level of conviction is well worth allocating to. So buy first. So typically when I think about, a millennial or a Gen Z investor looking to buy long term, I think that the mentality needs to be, right now I'm buying. Right now I'm only buying. You shouldn't go into it with the thought of, well, I'll buy here and I'll sell here. Of course, we all have to have risk tolerances and whatever, but because we're so young, we have so much firepower, which is time. It's best to be in a mentality of a buyer. Buy only, accumulate a position. If Apple's down 20%, buy more Apple. If it's down 5% more, buy more Apple. If that's your conviction, if that's what your allocation is, think like a buyer. And then as the markets move, right, as the years pass, you'll see different components of the portfolio do well and others do poorly. Using this buy first, sell first mentality, you would buy into whatever it is you're buying into very consistently, or at least mirroring your sort of level of conviction and your own personalized plan and ability to put forth cash. And then when things go haywire, you look at your portfolio and you see what's working and what's not. If you need to raise cash, the advice, the conventional wisdom here is to sell the worst performing piece. Sell the worst performing piece and reallocate into either something else you want to be exposed to or something that you think is working and you have even higher convictions on. Now, the opposite is true when you are a shorter term horizon investor. You're closer to retirement, that sort of thing. You want to sell your best performing stocks first, and then you want to buy into other allocations like fixed income that can lower your risk profile. That's kind of, you're entering the investment curve, and then as retirement, you're exiting the investment curve, and you need to sort of flip that advice. But for us, for buyers, we need to think about buying first, not to be terribly scared of market volatility, especially if it gives you discounts on positions that you have high conviction on. And then if you need to raise cash, sell stuff that's not working, or what I would advise is sell stuff and reallocate into something that gives you either better diversification profile, a sector that you never had exposure to, or something that you have extremely high conviction on. So part 2 of this chat, trying to keep them a little shorter, is Japan, the Japan story. So if you've been following me for a while, you know that I love Japan too much, almost to a fault. It's been a fairly stagnant economy, advanced economy, developed economy, high standard of living, very high density cities, very high technology that we see across our daily lives and we interact with. Amazing brands, amazing firms, but just have not performed when you compare the Japanese market to the US over the last several decades. Why has this happened? So in the 80s, the Japanese economy was explosive. They were manufacturing high-tech goods, high-quality goods, exporting all over the world, technology beyond most countries, especially at the consumer level. And the economic boom was impressive. It was a little bit of like we thought of China, I would say 10 years ago. We thought China was going to just economically swallow the world with their low-cost manufacturing. Japan was a little bit different. It was high-quality manufacturing, high-quality services. entertainment, luxury, consumer goods. It was a well-rounded sort of boomtown economy. And so the government, in order to maintain this, opted for easier monetary policy. So they kept interest rates low. They continue to do so to this day. And many economists look at the Japanese economy and say that this is the reason that the economy has gone through some stagnation, has gone through some contraction, has had what they call a lost generation of millions of Japanese citizens who didn't quite make it onto the rails of a career in Japan and live in a kind of, antisocial sort of way, and it's caused, fundamental problems for their society. Today, or yesterday, we got a shocking piece of news from the Central Bank of Japan that has consistently kept monetary conditions easy because they're, I guess, afraid of what would happen to the economy if they decided to abruptly raise interest rates, given that it's not a very fast-growing economy. It has these kind of structural issues with their population. And the central bank actually said, hey, the rate we have is actually a suggestion. And I'll go out on a limb and say that this is characteristically un-Japanese. I feel as though when they make declarations and rules, they're clear and they are firm. There's little leeway and high expectation that it should be complied with. So for the Japanese central bank to use this language has raised eyebrows all over the world and has had an impact on the bond market. Why? Because Japan is one of the largest investors in U.S. debt. To some extent, the Japanese pay our bills here in the United States. They buy U.S. treasuries by the boatload. They are the largest, if not the second largest holder of U.S. debt in the world. So this sends a shock across the global market because it says, hey, if Japanese interest rates are going up, we're probably going to have local Japanese people and businesses sell their U.S. treasuries and their assets and buy Japanese debt. And that could have, effects on the U.S. yield curve. And in fact, we have seen some volatility in U.S. treasuries. We saw a little bit of volatility around that message. So just some food for thought there with the Japan story. Now, we follow that story of sort of debt across time and space. Now they're exploring raising interest rates to try to shake things up with their economy. At the same time, we're seeing a lot of attention from emerging market investors. These are investors that like to invest outside the United States in countries they think have enormous potential. Japan is not considered an emerging market, but there is a theme that's manifesting across EM investors that is sort of outflows from China. Who are the biggest beneficiaries? And the beneficiaries will realize enormous growth. So Mark Mobius, I sent through an interview of his on CNBC this morning on the Discord. He's a great EM investor. He has there are plenty of critics. There have been periods where he hasn't done well, but I've always admired his conviction, his desire to invest abroad, to get in the weeds of emerging markets and immerse himself in other cultures. And he is incredibly excited about Japan and South Korea in particular, based upon these outflows in China and based upon what he's seen in technological advancement. More so, he speaks on South Korea. But if you guys have been paying attention, that's been probably the only additional position I've considered for the model portfolio is a South Korea ETF. Just in order to expose myself. I'm with Mobius on that one. I think that South Korea is not just an innovator with high quality companies, but I think they're also having an incredible moment of cultural export and boom in sort of media and entertainment and that sort of thing that can translate to consumer goods, more media, more travel, tourism, further export of their products and industries. So we love it. We love emerging markets. We're bullish on sort of Asia ex China, something we like, something we're considering for the model portfolio. And again, no changes. We haven't made any changes to the portfolio. We're beating the market. We're happy. So that's how we have Friday. Take care, guys. We'll catch up on Monday and stay tuned on the Discord. We're going to have a lot more content coming through. Take care.